Okay, we are at the top of the hour here. So good morning. Thank you all for joining us for this week or this month's session of Coffee Talk. My name is Sean O'Brien. As most of you know, I'm the president of QuickRate, and I'm always pleased to be joined on these presentations by Steve Huntington. Steve is our director of analytics. Steve, do you want to go ahead and introduce yourself?
Thanks, Sean. Good morning. Thanks again for joining us, everybody. Looking forward to another hour or so of answering your questions and kind of walking through everything we're seeing today with CECL and the regulatory and accounting environment. My background, I've been spent my entire career working with community financial institutions on everything from strategic planning and valuation work to M&A advisory and capital planning and model management. And I've been working specifically with Sean here and QuickRate to try to take all that knowledge, all those tools, and put them into an environment that's a lot more accessible and clean and sort of easy to use for credit unions. So thanks for joining us.
Great. So just a few things we're going to cover here today. Again, for many of you on the call, this might be, we think it's your first time attending. So we're always going to provide with a just quick introduction of the CECLSolver. Steve will talk about, the new loan segmentation and some of the changes that the call report has wonderfully provided to us this quarter. We will talk about Q factor details. We'll talk about some adjustment for held to maturity securities that we're making. And then, as always, we will take your questions throughout the presentation or at the end. Just a reminder, we are in presentation mode essentially, which means you're muted. So please, just click on that Q&A box or the chat feature and submit those questions. The chat feature allows everybody to kind of see the questions. So please go ahead and submit those, and we'll take those again, either throughout the call or just later at the end. That's really why we're here today. We want to give you an opportunity to ask questions. We recognize that many of you may be at different stages of the CECL process. We try as best we can to accommodate and address that in all of our sessions. So that's why we'll show you a little bit about the tool, but we also want to take specific questions that you might be encountering as you are in different stages of that CECL process. And then we want to share that with our audience so that we can, again, hopefully in many ways, treat this as a user group and, just raise everybody's collective awareness and knowledge, not only around CECL, but also the CECLSolver as well. And so we really think this has been an effective way to communicate with you, our users, and we'll continue to do this not only through this year, but even into next. So thank you all very much for joining us today. So at this point, I'm going to turn it over to Steve, who's just going to briefly walk you through our CECLSolver. Steve?
Thanks, Sean. And again, as Sean mentioned, this is a bit of a different, little more informal of a format. So when you have questions, just shoot them right into the Q&A, and we'll take them as they come. There's one coming in right now. We had some kind of pre-selected ideas for things we wanted to touch on today that we've been seeing going on, but we really want to see those questions come in as much. So don't be shy.
Steve, let's just take this one right off the bat. Yeah, it's sure. Right. It's top of mind. So
it is.
With all report changes having happened, when can we expect QuickRate to have 331 data available to simulate the Q1 calc? Steve, this is right up your alley.
Yeah, so we're neck deep in finishing that up right now. Since we now have access to all those call reports, thousands of them, which have come in over the last few weeks here, and they're pretty much all done at this point coming in, unless you're a late filer. So we hope to have all the 331 revision of a tool with all the new segmentation and that data hopefully next weekend. Not this weekend, but next weekend. If that's going to be delayed a few more days, we'll let everybody know. But the expectation is it'll be about a week from now that we'll be ready with all that. It was certainly a big revision of the way the tool works for us, just because we have all that new data for all that new segmentation, specifically around the new detail and granularity we have on different types of commercial credits. Good question. And we'll show you exactly what that's going to look like in just a minute, actually. I'm just going to talk on these couple slides, and then I might actually do a quick live demo for just a minute or two so you can see exactly what that'll look like on the tool in a few days. So for
Steve, let me
those,
just jump in real quick. So
yeah,
we had a kind of a follow-up comment on that. Assuming beginning Q2, the data would be available much sooner. Absolutely, right? So as Steve mentioned, he has been knee deep along with our IT team trying to incorporate these changes. And so next quarter will be on a much different and much more expedited process. The delay this quarter is really reformatting our tool, as Steve is going to show you today. And then he and our team are in the final stages of testing.
yeah. And we've been working on it for a good while, but of course we didn't get the final changes until earlier this year. And then until we actually had all the data, you don't know how everything's going to react. So we wanted to make sure that everything was all tied up with a bow before we released it. So we've been testing all of our changes now that we have all that data, and we're about done doing so.
And then just one more thing, Steve. There's a comment. Can a blast email be sent out when the data has been rolled as of 3/31? Absolutely. So we have that email ready to go. As Steve said, our intention, just as a foreshadowing, is to have all the final testing hopefully done next weekend. But yes, we will send out a blast email once the information is available.
All right, so a lot of the people on the call are certainly familiar with our tool and are using it. We do have people on the call though who have not seen the tool before, so I just want to spend just a couple minutes real quick summarizing the way it looks and the way the tool works. So what you're looking at on this slide is just a screenshot from the summary of our interactive tool. Our whole tool lives on the cloud, in the cloud, meaning that the first time you log in, all of your historical data, charge-offs, recoveries, balances by segment, by call report segment, going all the way back in time, is already preloaded into the tool, in addition to peer data as well. So when you design a peer group, that data automatically pulls into the tool and gets updated on an automatic basis as well. So the tool is, excuse me, not only do you kind of have it, I wouldn't say it's actionable results right out of the box, because we do need to work with you on doing some warm calculations and certainly the process of qualitative factor adjustments. But the fact that the tool is completely interactive means that whenever we get new data, we update it on the fly. Whenever you change any input or assumption anywhere in the tool, the entire tool recalculates on the fly instantaneously, pretty much. So that's a huge benefit when you're working with different scenarios. You know, if you run your CECL model this quarter, then you run it again next quarter, and there's a huge difference between the two. You need to be able to track down where that difference came from to make sure that, you know, your assumptions are correct. And we see that a lot with some other more complex methodologies where there are tools built where you've got hundreds of inputs and assumptions, you plug everything in, and then it spits out one number at the end. And then you don't know, you can't really explain why that number is higher or lower than you expected. And it's very hard to figure out where that is coming from. That's not an issue with our tool, because again, as you change anything about it, any input, you see your CECL, your segment level CECL and your total CECL requirement recalculate on the fly. So very efficient, we think, from a model management standpoint, so to speak. We're utilizing the weighted average remaining maturity methodology pretty heavily. It's one of the more straightforward methodologies that's been vetted and approved by FASB and the NCUA for CECL compliance for, you know, the vast majority of credit unions by asset size. We start with weighted average remaining maturity calculations, unsurprisingly. And then once those are entered into the tool, it really takes over from a mathematical standpoint, goes back in time, calculates your historical loss rates, lifetime loss rates by segment. And then we start helping you with your qualitative factor adjustments, right? How are we adjusting our historical experience for our best expectations of what we think we're going to see in the future? And a huge help for that is utilizing peer data. That's one of the reasons we start with the call report segmentation to begin with, is because not only does it give us access to your data, so you don't have to be constantly plugging that in and reconciling accounts on an never-ending basis, but it also gives us data from outside your four walls. You know, if you haven't had any losses in your first mortgage portfolio over the last 7 years, but you still have to justify having some sort of a CECL reserve on that segment with no loss history yourself, it becomes very helpful to be able to look outside your credit union and say, hey, for all the credit unions in my state, in my asset size, look at all the first mortgage loans and see, you know, what kind of losses there are in the environment around you, and use that as part of your justification or your narrative around your qualitative factor adjustments. Our tool does a very good job of that. So this, as you can see here, we walk you through the steps of doing the calculation. We allow you to strip out any loan balances that are not appropriate for CECL, whether it's PPP loans, whether it's SBA guarantees, whether it's fully share secured balances. We have a separate module for the individually assessed loans. If you have any that are significantly problematic that you need to cull from the herd and manage on an individual basis, you can do that from within the tool as well. And we have a more robust qualitative factor adjustment tab now, where you can add in adjustments for, you know, for peer data, for economic trends, for all those internal Q factor adjustments that you've always been doing as part of your ALLL methodology, you know, changes in mix, changes in underwriting standards, all that kind of stuff. The tool is designed to manage all that from right within it. Next slide for just a second, Sean, and then we'll get to that. I think that next question.
Okay, I was going to say, do you want to take the question or yeah?
Well, let me see. Yeah, what the heck? Does the user configure the loan categories, or is it a default setting from the call reports? So by default, at the beginning, when you first log in, it's organized by the call report segments that we have, which of course is changing this quarter. But however, we always allow you to add custom segments if and where you need to, custom risk pools. So at the bottom of the default segmentation, there's a plus arrow. You can add custom pools. Of course, you'll have to do a little bit more of the legwork. We won't have some of that historical data for those custom segments because they're, you know, it's not public. We won't have perfectly apples to apples peer data, but we can certainly work with you on that. And the tool is flexible enough to allow for that. On this second slide here, it's that same summary slide. I'm just highlighting the way you we designed the tool to be very easy to manage. Once you've plugged in everything for a scenario, you click on save it as a scenario. Everything you plugged in is saved. You can come and access it anytime you want to. You can have as many scenarios as you want to. In fact, the whole concept here is that this should become a repository of all your saved CECL scenarios over time, so we can track how it's changing as we get closer to implementation and then as we move forward. When you're done, you're always going to want to export it. Certainly, you can export our tool. You can export. You have full control over how much of a data you want to export, depending upon your audience, right? If it's for the board, for a summary, a quick quarterly summary, you might just take the summary tab. If you're exporting it for your auditor or examiner and they want the whole nitty gritty, you can export all sections of a tool with all the historical data directly into an Excel environment or PDF. Question come in. Oh, go ahead, Sean.
Yeah, I was going to say, do you want to take this question? Is this system driven only by call report data and therefore run quarterly versus monthly? So Steve, you want to take that and I'll add my comment?
Yeah, it's the financial data by default is updated on a quarterly basis because that's where we're getting all that data from the call reports. However, that does not limit how often you run the report or when you run it as of. Certainly we're getting the industry long-term trends on a quarterly basis. That's the most of the data exists pretty much in the universe. As far as updating the tool for your current balances as of any point in time, and then changing and updating qualitative factor adjustments, those can be done as often as you need to, and as of whatever date you need to. So while some of the data certainly only comes to us quarterly, the tool has the flexibility to be running it on a monthly basis and as of whatever point in time you see fit.
The next question is, can this be linked to an API? So I guess it could be. I'm not sure what you'd be gaining from it. I mean, I think the tool is designed, again, as Steve said, right? A lot of it's call report information. If you're looking to do something more loan level where an API might make some sense, you know, again, that's probably more something for our IntelliCredit side of the house. Steve, anything you want to add there?
No, typically that would be done because you have a very large amount of data that you want to be plugging directly into the tool on an ongoing basis, right? Which makes perfect sense if you're doing a loan level type solution. It's just not, I don't think it's something that's going to be it's probably not worth worth your time for this tool. We're pulling in all that historical data automatically from the call reports on a quarterly basis. As far as updating your balances, that's just a handful of numbers. The peer data also comes automatically. If you're looking for a methodology where you're doing a loan level PDLGD or a different type of methodology, that's probably where we'd want to talk to you about our IntelliCredit solution, which is really designed to handle some of this stuff at the loan level as opposed to the portfolio and public level. John?
Yeah, and I would just add there, right? I mean, part of this again gets to what are you looking from a solution, right? I mean, again, if you want to perform all kinds of extra work, that's fine. I think we start with the position for most credit unions. We're going to transition into CECL, and if your reserve is quite a bit defended by Q factors today, or your loss experience has been pretty benign, that extra level of granularity might not be necessary. Now, on the other hand, it may be, right? You may run a very low reserve and you need to do that. So again, I think it's different for every credit union, but
and it's dependent upon the data that you have, right?
Right.
Smaller, not just smaller, lots and lots of credit unions. We work with hundreds of credit unions on our CECL tool, and we see loan level data on a regular basis. And a lot of that loan level data doesn't have all of the fields necessarily, or the cleanliness in the data and the consistency necessary to do some of those much more complex calculations in an accurate and consistent way. And so that's something to take into account. If I would only be doing those methodologies if I felt that it was absolutely necessary, because I was a pretty large credit union where I had very specific issues with a part of my portfolio in the past that I need that loan level data. And in those cases, that's something we'd want to talk with you on a one-off basis to come up with a solution for you. But I'd say probably the vast majority of credit unions, not only on this call, but also in the entire country, the portfolio level warm-based approach is going to get the job, is certainly going to get the job done. And it's not something, that's not a conclusion that we came to just because it serves us or out of thin air. We developed this tool with FASB, with the NCUA. We worked with the accountants over at the NCUA in developing it. We've shared it with them on multiple occasions and gotten feedback from them. They see it on a regular basis when our customers go through exams. We've performed a SOC audit on the tool and have auditing firms that use it as well. So we're very comfortable with it being an appropriate level of detail for CECL for most credit unions. But if that extra level is necessary, then we can talk with you about it and come up with something to help you.
Got a couple more questions, Steve. How does CECL handle loan participations when we purchase a percentage of a pool?
Yep. So for loan participations, the question really becomes, do you have significantly different expectations for losses for a loan type for your participations versus your organic loans, right? If you have a pool of used vehicle participations, but they are in market and they haven't really performed that different historically than your organic used vehicle loans, and you don't have hugely different expectations going forward, then the question really becomes, am I gaining anything by adding them as a separate risk pool? Do they have significantly different risk characteristics so that I have to do that extra work? Sometimes yes, sometimes no. If the answer is yes, then we certainly can help you with that here. We do have data on participation loans that you can utilize within the tool. It's not additive data, meaning that participations can come from lots of different call report segments on the portfolio, but we also have some memo items in the call reports that give us some data on participation. So if that's a big issue for you and your credit union, I'd suggest doing a walkthrough, calling our sales team and doing a walkthrough with us so we can kind of look at your specific situation and come to a comfort level as to how we want to manage the participation loans. But however you want to manage it, the tool does allow for it.
Great, Steve. Another question has come in. How do you look at forward prepayment assumptions under the warm method, given changes in interest rates that we have recently seen?
We've never talked about this before at all. Certainly not earlier this morning, Sean. Go ahead. Take us.
Yeah, I was going to say, so, prepayment assumptions are something, that obviously are impacted by, by the rise in interest rates. So the kind of experience we've seen in the past, isn't going to be necessarily reflective of what we've seen going forward. And again, it's part of the challenge always with assumptions. Obviously, this is something you can evaluate on an annual basis. I think the important piece here are reasonable and, adequate assumptions are more than effective, right? Some reasonable assumption for a prepayment is probably enough. This is a rabbit hole that a lot of you and a lot of us can go down. We don't particularly see it as being, worth the juice, as they say, for the squeeze, right? I mean, I think you want to have some reasonable and defendable assumptions. If you feel like you need to do more analysis, I would do that on an annual basis. Steve, anything you want to add?
Yeah, the prepayments are tricky, right? And keep in mind the effect that prepayment assumptions has on CECL depends very specifically on what area of the portfolio we're talking about. If you're looking at used vehicle loans that have an average remaining life of 2.5 years, or 3 years if you have a 10 versus a 15%, prepayment assumption, it's not going to amount to a hill of beans of difference in the overall warm calculation because it's just not over that long of a period. Mortgage loans, on the other hand, obviously prepayments can make a very significant difference in your prepayment adjusted warm calculations. You might find that you did a warm calculation and you're getting 17 years without taking into account prepayments. But we know intuitively that the typical mortgage loan over the last decade or two hasn't really lived more than 7 or 8 years from birth to death. So the ones you currently have already aging on your books certainly shouldn't be significantly higher than that once a prepayment assumption is built in. Now, do we expect prepayment assumptions to be declining moving forward? I'd say on the whole, yes, you would expect a rising interest rate environment like we're having now or beginning now would have an impact on decreasing the average prepayment assumptions, which would lead to slightly longer warms, which all things being equal would lead to slightly higher loan loss reserves, honestly, under CECL. CECL is all about estimating losses over the remaining lives of the assets. So if now we have something going on economically, which is making us estimate a slightly longer life for our assets, we may have to be setting aside a slightly higher reserve. But what exact assumptions you use, we've seen prepayment studies done that are great. We've seen them done by ALMs. I see someone in the chat who asked about, they've been getting some prepayment assumptions from your ALM provider, and should we trust that? And they're your best option right now, using your own historical loan level data to get historical prepayment assumptions. But the devil is in the details, or in the assumptions, right? Is your ALM provider just giving you a historical one? And if so, over what time period? Did they do a 7-year study to do average annual prepayments over the last 7 years, or was it over the last 6 months and then annualized, right? And then are they building in a bunch of economic assumptions to give you their projection? Because this should be a prepayment assumption moving forward, a forward-looking prepayment assumption. So even if you spend a ton of time doing a perfect calculation of your historical prepayment calculations, you can double it or have it just by having some assumption about how it's going to be different in the future. So as Sean was saying, the juice isn't always worth the squeeze. It's about your assumptions, reasonable assumptions, and having some documentation or narrative around those reasonable assumptions. Our tool takes an approach, hey, let's start with a relatively generic, relatively conservative prepayment rate, like 5-10% a year. And if you have good reason to bring that up to 15, 20, 25%, especially for things like mortgages, then do so. That's kind of our take on it.
Yeah, thank you, Stephen. Thanks to Leo for sharing those comments on your ALM providers. Again, that's an adequate way to do it. I guess I would just reemphasize having defendable assumptions are the important thing. How deep and how much time you want to spend on this, I would argue for most credit unions is probably, not necessary beyond some reasonable assumption. Just my.
Yeah, it's again, and this is something we got reminded of frequently directly from the chief accountants at the NCUA when we're going over a lot of the fine points of CECL with them, which we do on a somewhat regular basis. Even they said, let's just take a step back and remind everybody here, all of this is being done just so that we can estimate the future, which we know is not, a perfect thing to do. So if we knew exactly what prepayment rates would be on mortgages 3 years from now, we should immediately quit our jobs and go take over the mortgage-backed securities industry, and we could all make a killing. So the point being, everybody is aware, even all of your auditors and examiners are aware that these are best guesses about what we expect over a long period moving forward. So there's going to be a good bit of, from everything we've heard, leeway and softness in their approach, even after even into next year going forward.
Great. Steve, a few more questions have come in. I'd like to understand the tool's assumption for maturity, or is this calculated from the call report data in some way? So the WARMs are actually calculated from your loan level information. We have a tool that can help you estimate it. We do for a number of our credit unions calculate this on their behalf. Your core system may provide you with some type of WARM report, but we work with our credit unions to establish what those weighted average remaining maturities are that then get dropped into the tool. Anything to add there, Steve?
Nope. It's the one thing that we can't get directly off the call reports, right? They don't ask you guys to calculate WARMs for the call report. So whether you get it from a core ALM provider, whether we provide a spreadsheet and show you how you do the WARM calculation, and we give you that spreadsheet, you can utilize it however much you see fit. Or if you need us to handle the WARMs for you, because you just don't have anyone there at the credit union you can task with doing it on a regular basis consistently, we can do that for you too. So, but yeah, the historical lifetime loss rates are driven by the WARM calculations. That's kind of one of the central tenets of the weighted average remaining maturity methodology from FASB and the NCUA.
A couple more questions, Steve. How do you handle student loans that have a deferred start?
For
me, right? The thing that drives the WARM model are the maturities. So I would say student loans that have a deferred start, they still have a maturity date that we're going to be incorporating into the WARM. And then secondly, that might be something that might influence your Q factor as it relates to that pool. Ultimately, again, let's not lose sight of the fact that what drives this solution and this methodology are losses, right? So, a lot of this analysis, around that, right, is really superfluous to, what's your loss experience been in the past, right? That's ultimately going to be the foundation for the WARM and where this happens, because the WARM is going to look at losses over a longer period of time. So again, prepayment assumptions are going to potentially impact the WARM, but let's not lose sight of the fact that a lot of this is really going to come from the foundation of what your experience has been at the credit union. Steve, anything to add?
Yeah, I was trying to think of any ways in which it would be significantly different for a deferred start payment plan for a student loan, and I'd say under the incurred loss methodology, under our current reserves, probably is a huge impact. Because you're not taking that cyclical lifetime approach, right? Under CECL, it's less important anything that's going on an annual or annualized basis, and more so over the remaining life of the asset. So we're looking at these loans, we're looking at when we expect them to mature, and total aggregate losses between now and then, whether they happen in the next 6 months or 18 months after that. So not a huge impact. However, qualitative, as you pointed out, Sean, from a Q factor standpoint, if you have significant deferrals and you don't expect sort of a linear economic environment, right? If you expect the economy to be good for the next year and then horrible for the year after that, then you might have a Q factor adjustment for the student loans that say, we expect some of these to start paying that are on deferred status and have some more problems due to some expected future issues in the environment. But then you're making a lot. I've already made 6 assumptions in just that one sentence, right? So I wouldn't really necessarily treat them any differently unless you get some really good explanation for why you need to from an auditor or an examiner, in which case we would love to hear what that is.
Yeah. And again, I think, there's going to be, as Steve touched on it, and we've spoken to the NCUA, right? There's going to be a life cycle to CECL. So let's focus in on the transition and then fine tuning this thing as we move forward. And we'll certainly have the capabilities and abilities to not only evolve our tool, but also provide more loan level types of analysis and more granular analysis if that's necessary. Next question is, does your model pull in MBS pool prepayment assumptions, such as BAM model prepayment assumptions with the ability to run an array? We don't currently. We're going to try to incorporate some speeds. Again, a lot of these prepayment things I think are just, again, a little bit superfluous to the tool, but we are working to incorporate more of those into here as well. And then obviously in a rising rate environment, some of those historicals may not be as valuable. Steve, anything to add there?
Nope.
The next question is, what period of time are you using to derive the historical loss rate for the specific credit union used in the model? Your historical data, right? So we're going to have your call report and your actual loss data then to look back and review over the remaining maturity of your portfolio. Steve, you want to?
Yeah, so we see different tools, different methodologies take a different approach to what should the look back period be, right? And most of those approaches are really generic. They sort of they say we're going to use a 3-year look back period. Arbitrarily, we're going to use a 7-year look back period for the entire portfolio. When we thought about it, we went back to, again, what the purpose of CECL is, what it's trying to get to. And it's trying to get to losses over the remaining lives of the assets. So for loan segments that have a typically longer life, right? Mortgage loans, we're going to want to maybe look further back in history to get a feel for how that segment performs over a lifetime. Whereas on the other side, for loans that have a much shorter history, that have 1 year or less of a typical life, we don't feel like we need to go further back that far back into history to get a feel for how they perform over a shorter lifetime. So we actually match the look back periods to the WARMs. So every segment of your portfolio may have a different duration of a look back period depending upon how long the average life is of those loans. That's something that you see visually is very apparent in our tool. We highlight the look back periods for each segment in a different color so you can see what time period. I don't think we have a snapshot of it right here. But if we don't have any more questions in a minute, Sean, I'll make sure I remember to point that out visually on the tool as I do a little quick demo of the new segmentations in a minute, if we get to it.
Yeah, gotcha. All right. You want to jump to this slide or are you still?
Yeah. No, I think I pointed out. I think I finished up with so something we just recently added a couple months ago, just an added benefit for our users, no additional cost or anything. We had some requests from credit unions, from our users, to just be able to get kind of some financial snapshots, right? To be able to look at some summary level historical data over time for your credit union or for peers. And so we built a couple other tools in here, since we have access to all the call report data, where you can research any credit union in the country. You can take a look at where their branches are. You can pull up some mapping information, and then you can just look at financial highlights. So you can see, not just things like assets, liabilities, income, but also overhead expense to average assets, right? Efficiency ratios, loan mix compositions, that kind of stuff. And if you go to the next page, Sean, not only can you search by credit union, but you can also just kind of pull up what I call it a universe at a glance, right? if you're using our CECL tool and you're using one of the NCUA's peer groups, like NCUA peer group 5, which is $100 to $500 million in assets, right? And you want to limit that peer group to just, let's say, California. So you say, for CECL, I think I'm going to use NCUA peer group 5 in California, because I think that's a pretty good representation of my peer group. But you're curious now, who exactly is in that peer group and what do they look like? You can pull this page up, and in about 5 seconds, you could see all the credit unions in California between 100 to 500 million, and take a look at some of their financials, and then click on one and have it pull up their map and all their individual financials. So just an added benefit for our users, our CECL users, to give them a little bit of credit union analytics in a pretty clean layout. Sean?
Yeah, again, I think, I think what we're trying to do, as Steve touched on, is just continue to give you more information. Again, I think not to lose sight of the fact that, CECL can mean a lot of different things to a lot of different credit unions, right? And what we have tried to build here is a practical way to address CECL and make that transition. This will have a life cycle to it, right? There'll be probably an evolution, but first and foremost, always, CECL is much like the reserve methodology today, right? Our reserves are designed to cover expected losses. Capital is there to deal with unexpected. And so, I think this can mean, and people's approach can be very, very different. But we're just trying to really give you a roadmap to make this transition effectively, and hopefully, probably in some way that's been consistent with how you've handled the incurred loss methodology. Let me just check here. We got a question that came in. We really like Quick Rate CECL solution. Thank you very much. I find spending more time in figuring out the Q factors than anything else. Is this normal? I would say yes, that is very normal, right? Because, again, as much as CECL has tried to make this a very objective process, Q factors are still the subjective piece of it. I would tell you, though, let's not overthink it, right? You can go down rabbit holes on this. So, I think having reasonable and defendable assumptions are where you want to go. I think the important thing in regulators' minds are simply to understand how you might make those changes. But we can certainly talk to you about how, maybe to address those. We have those, and we'll be incorporating 9 commonly used factors for Q factors. So I think using the process they've used today with an additional forward-looking element is more than sufficient and adequate. Steve, anything to add there?
Yeah, I really think that that was the goal we were looking for. Hopefully, if you're utilizing our tool, we've taken a lot of the number crunching and all that stuff out of your hands, so that you can just focus on this on the subjective elements of CECL, those things that nobody can really take out of your hands. They're your responsibility as a management team to make these assumptions that have to be justified. So if most of your time is spent coming up with narratives around qualitative factor adjustments, that's time best spent doing exactly that, because that's what's going to make or break your analysis. Is hopefully not the number crunching, hopefully more you're making reasonable assumptions and then having a narrative around why you think that they're justifiable. And if somebody's taking that part of it away from you, then that's what I'd be worried about, because that needs to be management's opinion, and you need to be comfortable with it and understand where it came from and be able to explain it to them. Does that make sense?
Yep. Steve, next question. Can you show us the warm tool and discuss it so we have an understanding how burdensome it is?
Sure.
Yeah. You want to take that first?
Yeah, let me pull it up right now. So I'm on my other screen. I'm just logged into the CECLSolver, and I'm clicking on our warm estimator tool, which you guys all would have access to. It's popping up directly in Excel here. And so if I can share my screen for a second, let me do that. Let me share. Oh, you need to unshare your screen there, Sean.
Yeah, let me stop. Sorry. Okay.
All right. I'm going to share my screen, and there it is. Let me know when that's popped up.
Yep, I can see it.
Okay, so this is the Excel tool that we designed to help you guys with the warm. It's very straightforward. For each segment of the portfolio, the call report segment, there's a different tab, right? So let's go to used vehicles. So for all your used vehicle loans, the only information that you need to calculate a WARM are current balance and stated contractual maturity date. That's it. So if you can get a pull down from your Aries file and then drag all your used vehicle loans into a bucket and then simply pull current balance and stated contractual maturity date, the rest is just some math. That's right here. So the highlighted stuff is what you'd fill out, you know, the date, the balances, the maturity dates, and then some sort of a prepayment rate assumption, and type in whatever that is, and you can adjust the prepayment assumption and see how it affects the WARMs. That's the only data you need. If you're having trouble with that information, or you don't have anyone there at the credit union that you can task with doing the WARM calculations on a consistent basis, let us know, and then we can help you. We can set up a way for you to securely share the that loan level data with us from your Aries file or wherever, and then we can help you with the WARMs, and then we would provide you with a spreadsheet like this that showed those WARM calculations. It's something that we provide as an added part of our tool if you're interested and need it.
That's great. And so thank you, Emily, for the comments about using the WARM calculator. And then secondly, thanks to Pam for your comments on the chat regarding your Q factors and environmental factors. A couple of additional questions have come in, Steve. Can you explain more around unfunded commitments and why they are incorporated into this calculation? So
that's why I pulled up the tool
Steve
here.
brought it up, so Steve, I'll let you go here.
Yeah, sure. So unfunded commitments are a very small piece of the puzzle dollar-wise for the vast majority of credit unions out there. So it's not something we want to spend weeks pulling our hair out about. However, it's not something we can completely ignore anymore. In the past, the call reports haven't even asked you guys to do a calculation for an allowance for off-balance sheet credit exposures. Under CECL, we're all going to have to do it. But it's a little bit hypothetical in nature, right? There's not a lot of great guidance for it. And what they're asking you to do, in effect, they're asking you to estimate potential long-term future losses on loans that don't really exist yet, right? So it's all a little bit hypothetical in nature here, but there's going to be a new line item on your call report starting next year, which asks you to calculate an ACL for your unfunded commitment. So we added a module into the tool that helps you do exactly that. Don't worry about the output numbers here yet. This is not a public version of our tool with live data. It's just sort of an example so you can see how the unfunded commitments works. The way it works is, we can pull your unfunded commitment values by segment directly from the call reports. Segmentation isn't always apples to apples, of course, that would be too easy. But we get what we can from the call reports. Then we work with you to subtract or net out any that are unconditionally cancelable. Credit card lines are a perfect example of unfunded commitments that are pretty much the definition of unconditionally cancelable. Unsecured share draft lines are typically, overdraft protection commitments are typically cancelable as well. Whatever the difference is, whatever's not cancelable is the net unfunded commitment that you have to deal with from a CECL perspective. Once we know what that value is, we have to do some what ifing here. We have to estimate what the likelihood of funding or the probability of funding is, and then how long we have those commitments for. And then finally, if they were to be funded, what kind of losses might we see on them over their remaining lives? So some steps here. We do give you some good default values for estimated probability of funding. It's not something that's readily available or easy to calculate, or most people have ever really seen out there, nor is there good industry data on it. Of course, there is some industry data on it, and it comes directly from the NCUA in their risk-based capital guidelines. And so that's where we give you a lot of footnotes down here explaining in detail where these come from and some best practices for calculating them. And those are the steps you take in order to come up with some sort of a small, it could be a couple $100, it could be a couple $1,000. It's not going to be hundreds of thousands of dollars unless you are a $10 billion plus credit union for unfunded commitments. But once we've done that calculation, we go back to the summary, and down at the bottom, there's a separate line item. I know it's not filled in right now. Again, this isn't live data. that manages the unfunded commitments in the summary tab. So that's how the summary tab is managed. If I could go back to the earlier question about about the look back periods and about the new segmentation. So what you see here looks a little different from what I showed you on the slides. This is a demo version. Again, this should be finalized hopefully in a week. This is what it's going to look like. These are all your new segments. We don't have 9 additive segments anymore in the call reports. Now we finally have 20 totally additive segments. When I say additive, I mean from a charge off and recovery standpoint, right? We've always had the balances for these things on the call reports. What we haven't had is the past dues, the charge offs, and the recoveries for all these in an additive way. Now that we do, we have some more granularity around commercial loans, and so we have some more segmentation that's available to you guys going forward. So that's the big update for the tool. As far as the look back periods, to circle back to that, how do you guys choose the durations of your look back periods? I sort of just explained that a few minutes ago, but you can see visually all throughout our tool, and when you export it, by the way, what those look back periods are. So if you have a short life for your payday alternative loans and your credit card loans, you're going to have a shorter look back period, and that's going to be highlighted in blue. For your mortgage loans that are probably going to have a longer life on average, we're going back further into the future, so you're going to have more data there. Again, this is not all accurate data yet, but this is the way we manage the look back periods, and we think it's methodologically very sound. We've certainly shared that with all the auditors and examiners, and they've agreed with us. I can keep it here if we have more stuff that involves the interactive, or you can take it back, Sean, depending upon the questions.
Let's leave it there until we get through the questions.
Sure.
Questions around the unfunded commitments and why those are incorporated. Our Aries file does not have a maturity date. Do they usually have this? I think, unfortunately, the Aries files don't typically have a maturity date. So again, a lot of our credit unions will send us a core export that will include that. I think there's, a way we can solve for the maturity date, Steve. I think in the Aries file, I think there is, the maturity, there is some maturity reference in the Aries file. And so I think we
get it sometimes. It's all depending. Yeah. The data, it's something we're very familiar with, to say the least, right? We see lots of data from credit unions all over the country, and it runs the gamut in its completeness and what data we have to work with. But everybody knows, including your auditors and our examiners, that you can't get data. We're all limited to the data that exists in the universe. So whatever data you have, we will work with to come up with the best estimate. If we can't find maturity dates easily on your Aries file, and we still have to calculate an average remaining life. So we'll use the data that's there to estimate. We'll look at your payments data, right? And we'll kind of project out similar payments to when it would get to a zero balance, and then add in some prepayments on top of that. So we'll work with you and whatever data you do or don't have to get the best estimate. And then it is what it is at that point, right?
Yeah, exactly. And so I think there is a month remaining months. And so again, we can figure it out. So as Steve said, we'll work with you to help calculate those warrants. But the idea is that we would send you back that summary page if we're calculating your warrants with the remaining maturities for each of the pools selected in our tool. All right, so Steve, let's go back to the presentation. I think we got the questions there. So if you want to
go ahead, I'll unshare.
Yeah, let me take it
All
back.
right.
I will throw up my screen again. And then again, I think you were starting to talk about this new loan segmentation. So if you want to pick up here with the changes to the 5300.
All right, yeah. So I already showed you some of the new segmentations, but just to detail, I mean, I don't know how much you all know this by now because you all just dealt with it in filing your call reports over the last, about 2 weeks ago. But we went to 20 distinct additive categories with regards to credit quality, right? Charge-offs, recoveries, and past dues. All those memo items that we used to have from a loss perspective that were helpful but not that helpful. Have now all become additive. So now they are much more helpful. Certainly, the biggest challenge is establishing long-term loss experience on all these buckets now that we have all these new buckets. That is certainly the big challenge for us. And so we worked with all the relevant parties to come up And wherever we've made an assumption where we say, hey, this segment didn't exist until this quarter, I need to estimate long-term historical losses so that I can then project that forward. We look at the segmentation that existed, pick the most apples to apples, the most comparable segment that does have historical data, and fill that in going back. And then we footnote it right there. So we say, hey, before this date, we're using, member commercial loans secured by real estate as a proxy because commercial and industrial didn't exist until now. Something along those lines is what we've done, and we footnoted it so that you get the best long-term trends possible, so that you get the best help projecting possible. Next slide. This is what it used to look like on the left, right? For charge-offs, recoveries, past dues. That's what it is on the right. So all that red stuff is all new starting last quarter. Again, you're all aware of this at this point. And then the next slide, all the red stuff is brand new. So just a ton of new information on the delinquent loans, which we're starting to capture all that as well. And we'll add that even more into our process and available data trends going forward. Next. This is just so you have in your presentation, in your slide deck, kind of a snapshot of what I just showed you on that interactive tool for a couple minutes. This is an output from our Excel template, but you'll get the feel. You get the feel from this screenshot as to what it's going to look like. So you can all take that and start making your notes and expect that to be live in the next, hopefully by next weekend, if not very soon after. Next. Okay, what you need to know, right, for the transition. So your old scenarios will still be available for reference, right? You won't be able to take, if you, these are for current users. So your old scenarios were based upon segments that are now, thanks to the NCUA and the call reports, a little bit different. So we're dealing with apples to oranges. Your old scenarios will all still be there. They're not going to disappear. But you won't be able to take a scenario from a year ago and simply update it to make it a current scenario, because now we have new segments and new warms and new Q factors. So there's going to be a little bit more work to be done to bring your old scenarios into with all the new segmentation. But unfortunately, I wish there was a way to avoid that, but there is not. I think the other things I already sort of spoke to. So just things to remind our current users what they'll want to do the next time they run a scenario after a week from now or so. John?
So Q factors. So again, we've had this question, throughout these presentations. How do you deal with them? And how do we handle them in the tool? And so again, many of you probably already use these 9 commonly used and suggested Q factors from the interagency, in the ALLL. Our position is for you to continue to use these, right? These are things and part of your process that you've developed a comfort with, your board has, your regulators, your auditors have. And so, I think one auditor shared with me a way that I think makes a lot of sense in explaining how we can continue to use these and how we incorporate them into CECL. If you think about the ALLL today, you essentially do a current assessment of these 9 common Q factors. And that's really what has been your Q factor analysis in the ALLL. Now in CECL, you're going to continue to do that analysis, and then you're going to do that analysis on a look forward or a go forward or forward looking. And there may or may not be a separate adjustment that you want to make after you review those 9 factors in that way. That's one way of doing it. There's no prescribed way to do this, but I think that is a commonsensical and kind of practical way for a lot of credit unions to address Q factors, going forward. We are in our tool at the moment. Our IT team is updating our Q factor tab to incorporate those 9 factors into the grid, as well as our peer and economic condition analysis. So we're going to give you the ability to be more granular in these analyses if you want to. And again, this hopefully will be out by the time the second quarter numbers are released. Steve, anything you want to add?
And that's an if you feel like that's helpful, and you certainly don't, as has always been the case and will continue to be the case, you don't need to use all those factors for all of your segments. You may not need to use a lot of those factors in any of your segments. There are things that need to be considered, not things that need to actually have adjustments made upon. So even if we were to, in our tool, what we want to do, what we're going to be doing is presenting all 9 of them. But if 3 of them are irrelevant to you, you hit the garbage can bucket on top and those columns disappear completely. So it doesn't need to look any different from what it does right now without these 9 columns. We just thought they were good ones to stick in there kind of by default so that you can consider them. You can add an adjustment to one particular segment for your changes in your portfolio mix. You can add adjustment to all the segments, or you can remove the portfolio mix completely from the column. So it's really just some default guidance that we're providing if you want to do have those standardized ones in your tool.
And that's a great point, Steve, right? We aren't trying to prescribe how you do this. What we are trying to do is provide flexibility to our credit unions to handle this in however or whatever manner they would like. And so again, that's a good distinction to make. We gotta.
Yes, I mean, we could have managed this just by putting one really gigantic footnote at the bottom that explained all those common Q factors. We thought, let's stick them in there. People can use them if not, or if they don't want them, they can X them right out and get rid of them.
Yeah, and so the question came in. So if we like the old 3-column factor layout, we could keep that. Absolutely. That's the important distinction. We're trying to build in more flexibility based on requests and suggestions and asks from you, our users. But again, we are not prescribing a way you have to do this. We're simply trying to provide flexibility to handle it how you would like to do it. So
yeah, and that's something that we always keep in mind whenever we're adding things to our tool. One thing we know our customers, our users really like about our tool is that it's manageable, right? It hasn't become this overburdensome monster with 8 million tentacles that you don't feel like you can get your arms around and manage. So whenever we add additional flexibility, add additional tools, we always try to build it so that if you like the way you've been doing it, you can keep doing it that way. You don't have to have that additional granularity. Now, this change in the call reports was nothing anyone could do about other than, this new segmentation we all have to deal with, and some of the old segments won't be there anymore. So this wasn't an optional update, but a lot of our enhancements, certainly we keep an eye on the people that like the way they're doing it, can continue to do it that way.
As we close in on an hour here, and we're not quite through the slides yet, just a reminder, we will send out a link to the recording today, as well as a copy of the slides. And so you can look for that in the next couple of days in an email from us. And then we will also probably circle back maybe on some of these topics next month as we get closer here to the end of today's presentation. Just a reminder on how to participate. Steve, before we do that, anything you want to share on the new template for the?
No, I mean, this is also, if the unfunded commitments is going to play is going to play a very minor role in your overall CECL, this is probably going to be even more minor, but it is something we have to deal with, right? CECL also doesn't just pertain to your loan portfolio and now also to unfunded commitments, but also to your securities portfolio, potentially. It's only to held to maturity securities, and it only pertains to held to maturity securities that aren't government guaranteed. So the majority, or if not vast majority, of credit unions don't really have a whole lot of exposure to non-guaranteed, at-risk held to maturity securities in their portfolio. But if you did, you would need to come up with some sort of a basic CECL adjustment for that as well, for any potential losses. So we're working on a framework to stick that into the tool so you can manage it there. It'll be pretty open-ended. It won't look super fancy, but it will allow you to take any adjustment if you have one, relatively minor one likely. It'll be built right within the tool. So we're working on that also.
Great. So just a reminder again, I think this has been great. I hope you're finding these sessions really helpful. We love all the questions. That's fantastic. We appreciate the participation from you, the audience, also with others sharing their ideas or comments, based on the questions being submitted. We will continue to do this each month. Again, thank you very much for the questions today. I thought they were fantastic. An hour goes by very quickly with that in mind. Just a final reminder, next month we will have another guest panelist. We'll have Josh Bowen from Warren Averett join us, a CPA firm in Alabama, who's going to join us as a guest panelist. next week, Steve and Jason will be doing a deeper dive into our CECLSolver demo. So we encourage you to attend both or either of those. If in between you have questions about your portfolio or want to go through your data, just schedule a demo with us. We'll be happy to walk you through all of your information. And then I think, again, just join us again next month. We will probably touch on some of these topics as well, and then but also have a guest panelist to address additional questions or just provide another perspective with Cecil or any questions you might have. So, Steve, any closing comments before we let our audience go today?
No, I think that's about it for today. We'll make sure if you need a copy of the slide deck that you have that as well. And if you have other questions, shoot us an email, give us a buzz. And if you want to see your data, we're happy to walk through the entire tool, looking at all of your data and talking about the things specific to your credit union, so we can get you comfortable with Cecil without feeling like you've got to completely rebuild the wheel here when it comes to reserve accounting.
Yeah, exactly. Right. This is a process, right? Let's just keep moving together, taking questions, getting comfortable with it. Doesn't have to happen overnight. We'll be here to help. And again, appreciate your time and interest today. Thank you for the participations. The questions were fantastic. So thank you for submitting those. One more final one, it looks like. Let's see before we go. Oh, no, Wayne, thank you. Brian, thank you both for the questions today. That was fantastic. We'll see you next month. I hope everybody has a great weekend. And we appreciate all the attendance and the questions. And we'll look forward to seeing you next month. Have a great weekend.
Thanks, everybody.